Okay, Bismillahirrahmanirrahim. Assalamualaikum. Now we continue to look at the learning objective 3. That is to demonstrate how to compute cost of goods manufactured and prepare financial statements for a manufacturer. So income statement, so we have a periodic inventory system. We also have a perpetual inventory system, but don't worry about the perpetual inventory system. We look at the periodic inventory system. The income statements of a merchandiser and a manufacturer differ in the cost of goods sold section, or in short it is called as the COGS, cost of goods sold. Okay, in income statement for a merchandiser, you have the beginning inventory at the cost of goods purchased, because a merchandiser, you just purchase a item that is ready for you to sell, and then you minus the ending inventory. You purchase a finished good and you sell a finished good. But for a manufacturer, you purchase the raw material, you process, you convert that into a finished good, then you sell. So that is basic difference between a merchandiser and a manufacturer. If let's say you are a merchandiser, let's say you purchase this bottle, you purchase this bottle, let's say you purchase at a lower price, you purchase, let's say at a let's say you purchase at an 80 cent per bottle, and then you sell at 1 ringgit and 20 cent, for example. So that is a merchandiser. But if you are a manufacturer, that means you process the finish, you process the raw material and convert that to a finished good. But basically, to calculate the cost of goods sold, that will be the beginning inventory at the cost of good, whether it is a good cost of goods purchased or the cost of goods manufactured. And then you have to minus your ending inventory. Then only you get the cost of goods sold. Okay, to illustrate this, so that you will understand this better, we will look into three different scenarios. If let's say scenario 1, you have the production. In scenario 1, you have the production. You don't have any opening stock. You don't have any closing stock. So for your cost of goods sold, if let's say you purchase or depends whether you purchase or you produce. Okay, if let's say you purchase, so if let's say you have your purchases only or production only, so you only have, let's say you purchase 20, so that will be 20. That will be the cost of goods available for sale. That will be 20. And now if let's say you don't have any closing stock, so your closing stock is 0, so your cost of goods sold will be 20. Okay, in scenario 2, now I introduce to you opening stock. What if you have opening stock? That opening stock means at the end, at the beginning of the period, you have some in stock, so inventory. So let's say you have 7 at the beginning, and then during that period, you purchase or you produce another 20. So how many goods that you have? So the cost of goods available will be 27. And then you don't have any closing stock. So your closing stock is 0. Then your cost of goods sold will be 27. Now let's say I introduce to you closing stock or the ending inventory. Okay, closing stock or ending inventory. Let's say in the same case, you have opening stock of 7. Means you have at the beginning of the period, you have 7. And then you purchase another 20 or you produce another 20. So you will have 27. So that 27 is your cost of goods available for sale. So you are there are altogether 27. But at the end of the period, you still have 5 in your balance or your ending inventory or your closing stock. You have another 5. So actually, how much that you have sold? So your cost of goods sold will be 22. So that's how you calculate your cost of goods sold. So that's why you have your opening stock, add your purchases or production, and then less your closing stock. Okay, that's how you calculate your cost of goods sold. Okay, so that's why when you see for your income statement, you have your beginning inventory at the cost of goods purchased or manufactured, and then you have to less your ending inventory or closing stock. You will arrive at your cost of goods sold. Okay, next, how do you prepare for your income statement? Okay, to prepare for your income statement, if you are a merchandising company, then that will be your cost of goods sold. That will be your inventory, opening inventory you see at the 1st January. So your inventory, opening inventory at your cost of goods purchased. And then you have the cost of goods available for sale, and then less your ending inventory. So you will arrive at your cost of goods sold. If let's say you are a manufacturing company, again, you have the finished goods inventory because you manufactured your product. So you will have the finished goods inventory at the beginning or opening inventory just now. This one on the 1st of January. So you have the cost of goods manufactured, and then that will be the cost of goods available for sale. Okay, and then less your ending inventory, you will arrive at your cost of goods sold. Your cost of goods manufactured are your cost of production just now, right? So if you are calculating your cost of goods manufactured, that will be total manufacturing cost. That is your sum of direct material cost, direct labor, and manufacturing overhead in the current year. Remember, we calculate the product cost or the manufacturing cost. That will be the three components just now: the direct material, the direct labor, and the manufacturing overhead. And then sometimes you will have your work in process, or sometimes they use the term work in progress. They are all means the same. So these are the cost of beginning work in process and the total manufacturing cost for the current period. So you have the beginning work in process inventory, and then add the total manufacturing cost. That will be the total cost of work in process, and then you less the ending work in process. So you will get the cost of goods manufactured. So that is your cost of goods manufactured. So if you look at the cost of goods manufactured schedule, you will have the work in process on the on the beginning. That is, in this case, the January 1st, you have all the direct materials, and then your direct labor, and then your manufacturing overhead. So you will have your cost of goods manufactured here. This one, you are talking about the inventory and the opening inventory and closing inventory of your raw materials. But previously, you have looked into the income statement. That income statement is for the finished goods. Okay, this one is the one that you are producing in progress. So the raw materials inventory, the materials, the input here will be the materials that you have. Okay, but in the income statement just now, the income statement that you have here is the finished goods. Okay, this one is the finished goods, right? Because these are the items that are ready for you to sell. Okay, ready to be sold. So this one is the finished goods. Of course, you cannot sell the work in process. You only sell the goods which are already finished. So this one is for the finished goods. Don't worry too much about the income statement and the COGS. Just enough for you to get some idea on how to prepare the income statement, and it's basically to look at the how much is your cost of goods sold, right? Okay, so hopefully you have a better understanding about the cost of goods manufactured and the cost of goods sold. Okay, with that, I thank you.